Today, winter is coming. The Probably Imperative Weekly to the 1st of June 2019. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest weekly digest of finance and property news with a distinctively Australian flavour. And on the first day of winter down here in Oz, the economic scene has a distinctively winterish feel to it. US markets were down on more trade fears. The yield curve there inverted further. And in Germany, Deutsche Bank, one of the biggest systemic risks, continues to dive. And Italy got the shakes. And locally, a rate cut is all but locked in on Tuesday. But remember, this is a signal of a weak, that's W-E-A-K, economy. This is not good news at all. So starting with US stocks, they dropped on Friday as the S&P 500 closed out the month with its biggest May slump since 2010 after President Donald Trump's surprise threat of tariffs on Mexico fueled fears that a trade war on multiple fronts could lead to a recession. Washington will impose a 5% tariff from June the 10th, which would rise steadily to 25% until illegal immigration across the southern border was stopped, Trump tweeted late on Thursday. The Mexican president responded by urging his US counterpart to back down. Plus, data showed US consumer prices in April increased by the most in 15 months, but a cooling in spending pointed to a slowdown in economic growth that could moderate inflation pressures ahead. In response, the Dow Jones Industrial Average declined 1.41% to hit a new three-month low of 24,815. The S&P 500 lost 1.32%, 2,752, and the Nasdaq Composite dropped 1.51% to 7,453. Significantly, both the S&P 500 and Nasdaq closed below their 200-day moving averages for the first time since March the 8th, which is seen as a strong technical support level that could suggest further losses ahead. In fact, for the week, the Dow fell 3.01%, the S&P 500 dropped 2.62%, and the Nasdaq declined 2.41%. The weekly decline was the sixth straight for the Dow, its longest weekly losing streak since 2011. For the month, the Dow fell 6.69%, the S&P 500 dropped 6.58%, the Nasdaq declined 7.93% to mark the first monthly decline of the year for each index. Of the 11 major S&P sectors, only defensive plays of utilities and real estate were in the plus side, while 8 were showing drops of more than 1%. Investors have grown more worried about the deteriorating trade talks between the United States and China and have sought safety in government bonds. Technology and energy have been among the hardest hit sectors since May the 3rd as Trump ramped up tariff threats with Beijing. US Treasury Yields fell to a new multi-month low. The benchmark 10-year note dropped as low as 2.128%, the lowest since September 2017. It ended at 2.133%, down 0.41% on Friday. The yield curve, as measured in the gap between 3-month and 10-year yields, remained deeply inverted. And some investors view this as a sign of a recession as likely in 1 to 2 years. And the trade war is merely a sideshow. While a key slice of the curve has inverted this month for the first time since March, an adjusted curve that accounts for quantitative easing and tightening has been persistently inverted for the past 6 months, according to Morgan Stanley. In fact, the bank's metric inverted back in December, well before the most recent escalation of US-China trade tensions, and has maintained its shape ever since. That suggests investors who are looking to a trade resolution as a solution for the world's economic woes may be pinning their hopes in the wrong place. Get ready for more potential growth disappointments even with a trade deal, the strategist wrote in a May 28 report. They see a risk of the S&P 500 index falling to 2,400 from around 2,800 thanks to the softening data. Cited culprits for falling bond yields range from tensions in global commerce, relentless hedging demand to growth angst. Nearly $11 trillion worth of fixed income securities are now yielding below zero, the most since 2016, Bloomberg data shows. There's no shortage of evidence pointing to economic woes. Morgan Stanley points out US data from durable goods to capital spending and PMIs lagged market consensus last week, all of them reflecting activity in April before the latest round of trade escalations. In China, the economic outlook deteriorated this month after April's weaker-than-expected performance. Data released on Friday morning by the National Bureau of Statistics showed that China's Manufacturing Purchasing Managers Index dropped to 49.4, worse than the 49.9 forecast, and anything below 50 is bad news. It is possible that China could cut the reserve requirement ratio as liquidity tightens. And the People's Bank of China added a net 430 billion yuan, or $62 billion into the banking system this week, the most since mid-January. Those injections were a response to market jitters resulting from the government's takeover of a Chinese lender, the first in 20 years. Sentiment has also been dampened by the US-China trade dispute, which doesn't appear to be headed towards a resolution anytime soon. And that has sent the yuan towards its worst month since July, and the benchmark Shanghai Composite Index towards a 5.7% monthly drop. The Shanghai Composite was down 0.24% on Friday to end at 2,898. And foreign investors are in line to sell about 53 billion yuan of Chinese equities this month, smashing last month's records of 18 billion. Expectations for price growth, as proxied by five-year forward inflation swaps, are falling in the US and in the euro area. We think this means that the US economic slowdown and rising recession risk is happening regardless of the trade outcome. The strategist said the gap between 3-month and 10-year rates dipped to minus 12 basis points on Wednesday, the most negative since March, when this closely watched segment of the curve inverted for the first time since 2007. The 3-month fell 0.28% on Friday to 2.348. And Morgan Stanley warns its adjusted yield curve also suggests stock volatility is set to rise. The Volatility Index was indeed up 8.15% to 18.71 on Friday. Goldman Sachs fell 2.6% to 182.49, and the S&P Financials fell 0.45% to 437.11. Adding to the downbeat mood, Beijing warned on Friday that it would unveil an unprecedented hit list of unreliable foreign firms as a slate of retaliatory tariffs on imported US goods was set to kick off at midnight. Tariff-sensitive industries declined 1.46%. Gold was up 1.43% to 1,305 in a flight to security. Crude oil fell 5.69% to 53.37 a barrel, and Bitcoin was up again to 8,544 or 3.31%, having tried to break through 9,000 but falling back. Some are still predicting further gains, others falls. The euro-US dollar was up 0.44% to 1.1179, while the US dollar index futures was down 0.39% to 97.67. Europe remains in the doldrums thanks to the Brexit impasse and the continued falls of Deutsche Bank. See our recent post, How Low Can Deutsche Bank Go? On Friday, it ended at 6.066, down another 2.32%. This has fallen now more than 5% during the last 5 days, and an all-time record low. If Deutsche Bank were declared insolvent, this could be a falling domino that starts another Lehman-esque slide across the markets. Since the beginning of 2019, Deutsche Bank's stocks price has declined by about 17.5%. Going back 1 year gives us losses of 39%, and in the past 5 years, Deutsche Bank has seen its stock plunge from 38.74 to their current levels, which is a devastating loss of about 82%. What is even more alarming is that the overall trend in the bank's stock price is more than obvious. Over the past 5 years, it shows absolutely no signs of recovery. And as we discussed recently, the massive derivative exposures are where many of the risks may lie. In the UK, still trying to select a replacement Prime Minister, The shadow of bank failures was evident again, with Metro Bank shares falling 10% as 3 US law firms announced they were investigating whether the lender's bosses took part in securities fraud. Metro Bank is a retail bank operating in the United Kingdom, founded in 2010. At its launch, it was the first new high street bank to launch in more than 150 years. It has around 2,800 employees and 67 stores in southeast England, and it has 1.7 million customers. The branches are customer-friendly, with lollipops for children, pens prominently displaying the Metro brand, plus dog biscuits on tap. But its share price fell to 683.5 pence on Friday, down 6.24%, just days before investors were expecting to rubber stamp a £375 million capital raising to strengthen the lender's balance sheet. Metro Bank had revealed an accounting error misclassified when $900 million worth of loans were actually more risky than they thought. They were incorrectly categorising these commercial property loans as buy-to-let loans, which meant they weren't holding enough capital on their balance sheet. And as a result, Metro's mistake, revealed in January, prompted investigations by the Financial Conduct Authority and the Prudential Regulatory Authority. It went on to announce plans to tap shareholders for more cash just months after its last fundraising, when it said it wouldn't need any more. The bank later announced disappointing first quarter results, showing a 50% drop in profit and the exit of some of its large business customers, which pulled around £566 million of deposits out of the business. The run of negative headlines led to customer panic, where people tried to empty safety deposit boxes and withdraw cash. This has echoes of Northern Rock more than a decade ago and shows how applying wrong capital weights can create havoc for banks and its customers. The FTSE was down 0.78% on Friday to 7,161, and the Bank of Scotland fell 1.61% to 213.70. The pound US dollar rose 0.23% to 1.2636. Italy is another place to watch. The Italia All-Share Banks Index dropped 18% so far in May, almost double the 10% fall registered by the Euro Stoxx 600 banking index during the same period. One of the reasons for the latest deterioration is the ongoing, escalating standoff between Brussels and Rome over Italy's 2019 budget. For the moment, neither side shows any inclination to back down. On Monday, the Italian Deputy Prime Minister said that after the Euro elections, he has now got a mandate to push through tax cuts and fight for changes to EU budget rules, which went down like a lead balloon in Brussels, which hit back by threatening to fine Italy €4 billion over its rising debt and structural deficit levels. Since then, Italy's 10-year risk premium, the spread between the Italian 10-year bond yield and their German counterparts, has surged by almost 20 basis points to 289 basis points, its highest level since February. And that is particularly bad news for Italian banks, who are notoriously holders of Italian treasuries. After the Bank of Italy, they are the second largest holders of Italian debt. Italian government bonds make up around 20% of the bank's entire asset base, while other euro area banks, including even those in Spain, Germany and France, are net sellers of domestic government bonds in April. Italian banks doubled down on their purchases, buying up €7 billion more. This is one more to watch. Locally, the Aussie dollar is stuck in its narrow range ahead of the Reserve Bank of Australia meeting on Tuesday, amid bets for a 25 basis point cut. It ended up on Friday at 69.39, up 0.41%, thanks to a weaker US dollar, despite signs of slowing activities from China, Australia's largest trading partner. We know the RBA is looking at the local jobs data closely, and it remains to be seen if the RBA does reduce the official cash rate to a fresh record low, as recent data shows quite a robust labour market. But officials seem to retain dovish forward guidance and insist that without an easing in monetary policy over the next 6 months, growth and inflation outcomes would be expected to be less favourable than their central scenario. This would potentially feed into the finance and property sector, along with the recent APRA loosening, first-time buyer incentives, and of course the coalition government's return for another term. John Mott from UBS tabled these scenarios this week. Scenario 1, bounce back. A recovery in housing lending flow, up 20%, back to record levels, would add 2.2% to housing credit growth and 1.5% to earnings per share growth. But this would likely give rise to a sharp bounce in house prices and household debt. stimulatory policies would need to be reversed. Scenario 2, modest recovery, new housing lending bounces around 10%, adding 1.1% to housing credit growth and 0.7% to earnings per share growth. However, with rates remaining low, net interest margin pressure from deposit spreads and replicating portfolios hedges offsets credit growth. Delinquencies continue to rise given interest-only maturities. Scenario 3, stagnation, global environment remains uncertain, and an increase in expense assumptions, the HEM, offsets APRA's removal of the serviceability floor. Damien Boyer from Credit Suisse said, overall we see little new information in recent data releases. Growth has been diabolical. The real action will occur next Tuesday, not because the RBA meets and is forecast by the street to cut, but because the banks will have to decide how much to pass on. The magic number seems to be 12.5 basis points of the 25 basis points cash rate cut. This balances the margin required for banks and the need for transmission to the real economy. If delivered, it will probably allay recent concerns about the significance of wider interbank credit spreads throughout 2018 and bring into focus the recent sharp narrowing. But JP Morgan is turning increasingly gloomy on the outlook for the Australian economy, making the call that the Reserve Bank of Australia will cut official interest rates by 1% to just 0.5% by the middle of 2020 to reduce unemployment and stoke inflation, which are, of course, two of the RBA's key mandates in setting monetary policy. If JP Morgan's call is accurate, it would mean Australia almost assuming the emergency virtual zero interest rate policy, the ZIRP, adopted by the ECB, UK, US and Japan in response to the global financial crisis of 2008-9. These ultra-low interest rate settings were deemed necessary in 2009 to flood markets with liquidity in order to resuscitate credit markets, while all but bust banks were also bailed out with the Toxic Asset Relief Plan, the TARP, in the US and copycat programs worldwide. Moreover, with rates as low as 0.5%, the RBA would be introducing virtual quantitative easing, possibly without the debt buying, due to the flood of liquidity rates at this level would create. If Australia were to adopt such a policy despite a stable financial system backed up by the post-GFC Basel capital adequacy requirements and low GDP growth, it would be unprecedented and lead to a bunch of uncertain effects on its capital markets. It's likely that the Australian dollar would sink by another 10% or thereabouts versus the US dollar to make the US dollar profits earned by companies overseas worth significantly more to local investors. And there are more traders net long than short on the Aussie now, which may tell us something about future rate expectations. And to stress the point, those strategies of QE and low rates were triggered after a crisis, not in an economy which, according to the pre-election splurge, was strong, oh, so strong. So something just does not add up. Such low rates, by the way, would put more pressure on the banks too. On bank reform, I suggest the New Zealand Reserve Bank Governor, Adrian Orr, has painted a prudent reform program centred on lifting bank capital. As interest.co.nz put it, Orr was answering a question about New Zealand Banking Association's claims that the Reserve Bank's proposals to increase banks' regulatory capital requirements could cost households, businesses and the economy about $1.8 billion a year. After indicating he didn't agree with this, Orr said what was one of the interesting ones from NZBA, that at the end of the day, if banks fail, it should be our fault and we should pay them out anyway. This, he said, was in NZBA's submission, which he found astonishing. He was referring to a comment in a report by Sphere Research Group that was commissioned and submitted by NZBA. It outlines a bank crisis scenario where it suggested the government, meaning taxpayers, should take the hit rather than bank depositors. We have some concerns that the OBR, the Open Banking Resolution Policy, is being assumed to provide a bail-in, whereas it seems to us highly unlikely that any government would allow all depositors in a major bank to take a haircut. Depositors would have a right to argue that the Reserve Bank should have seen this coming, and as the government's designated regulator of the banks, the government should take the hit rather than depositors. Depositors are poorly placed to monitor the performance of their banks in contrast to the regulators, who have better information and a duty of care to the depositors. Requiring banks to hold additional Tier 1 capital would seem unlikely to be the best, most efficient method for managing these risks, the report argued. There are a lot of interesting assumptions across a lot of the submissions, particularly from those who are the ones who may be facing higher capital requirements, said Orr. We are wide open to do the right thing by the country, but we want more capital. We want good quality capital in this country because it's the well-capitalized banks that are in the long term the most sustainable and profitable. Good on him for that, because here in Australia less capital is required and we have total fuzziness about deposit bail-in as international regulators push for more concrete bail-in proposals. And as I said in my post this week, households will one way or another take the rap. See, when the music stops, who's going to be left holding the baby? Hi, excuse the interruption, but if you are getting value from this post, please consider subscribing to DFA if you haven't already done so, or ring that bell for custom alerts. Plus, please consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or subscribe via Patreon for as little as $3 US a month or more to get access to exclusive additional content. The links are in the comments below. And thanks for supporting what we do, it's really appreciated and makes it possible for us to continue to make more great content. Data from the RBA showed a further slowing in credit growth. As we discussed in our post, the credit monster still stalks the halls. Total credit in the system is still growing, with housing lending up to $1.83 trillion, with owner-occupied lending accounting for $1.23 trillion and investor lending $0.59 trillion. Business lending was $0.96 trillion and personal credit was $146 million. So you can see how significant housing credit is, and yet it is still growing. But to state the obvious, a growth rate of 3.9% for credit for households even now is way stronger than wages growth or inflation. So the debt burden is building further, and yet the policy settings are about to be shifted to encourage more of the same. The changes in the credit and property markets have been talked to death this week, with lines of economists and bank analysts calling the bottom of the property market. Macquarie, for example, said multiple catalysts have improved the domestic growth outlook. With positive housing catalysts in the last week, we are more confident housing will improve in 2019. Based on an average of 6 months, we could see month-on-month house price rises as early as July 2019. This should flow through to better growth in housing finance and building approvals. And CBA said that the number of borrowers seeking home loans from Commonwealth Bank surged to its highest level in more than 6 months, on the back of the coalition's surprise federal election win. CBA had, they said, the strongest week in more than 6 months. The home price data for May shows prices continue to fall, according to CoreLogic. And auction clearance rates did improve a little last week, although the volumes are still down and a considerable number of properties were passed in. In the next few weeks, I think this will be quite interesting to watch. One other fact worth dwelling on is that a new tighter HEM household expenditure measure framework kicks in from today. The expense benchmarks are a lot higher for more affluent households. And this may act as a brake on mortgage approvals, remembering that around 45% of applications are still using some version of the HEM. Funny how these tighter credit conditions appear to have been lost in all the hype. The ASX 100 ended up 0.12% on Friday to 5,284, while the ASX 200 financials was down 0.21% to 6,139. The local volatility index was up 0.52% to 1491, above recent levels, suggesting that risks are back on. NZ was down 0.46% on Friday to end at 27.88. CBA was up 0.4% to 78.51. National Australia Bank was down 0.04% to 26.49, and Westpac was down 0.65% to 27.44. The Bank of Queensland was down 1.17% to 9.26. Bendigo and Adelaide Bank rose 0.81% to 11.23, and Suncorp dropped 1.21% to 13.03 after the CEO was announced would be leaving. Macquarie was down 0.10% to 120.31, and AMP fell again, down 0.46% to 2.17 on more class action news, this time relating to fees for no service. Real estate agent McGrath continued higher on new optimism in the property sector, up 1.79% to 28.5 cents, and Mortgage Choice, the aggregator, also rose, up 1.71% to 1.19 on the prospect of more business and weaker government intervention in the sector under the coalition. The Aussie Gold Cross was up 0.93% to 1,880. So the global economy winter does seem to be rolling in, with more trade issues, yield curve inversions and potential bank failures. Locally, watch for the rate cut and the flurry of buy now, great rate talk, despite the hollow ring this has as the local economy weakens. It seems to me it's a race to the bottom, and the only question now is whether the global crash hits us first or whether the local economy triggers problems here before. Either way, those at the optimistic end of the spectrum appear to have conveniently forgotten the context of the so-called good news on property. We think a more balanced view tells a rather different story, and so people should be careful if they choose to step into the property market just now, not least because sellers have started to demand top dollar, so buyers, beware. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.